All right. Well, it's 7:15. I guess we'll start here with our weekly call. Um, this week we're going to touch on U.S. corn, some of the dynamics we're seeing going on, mostly here in the U.S., but some of the things that are driving some of the spread markets, some of the cash markets. So we'll get rolling here. If there's any questions throughout, please let me know. So, first thing, corn balance sheet. We all saw what happened with WASD. I think the key here is little lower yield, little lower carry out overall. I think one of the things we'll have to continue to watch here is U.S. corn exports and final ending stocks. I'll touch on price later, but I think one of the keys when you look at the expected farm price the USDA gives, and then I put ATI's numbers for lower carryouts, higher carryouts, and what that does with price. And kind of the key here is you're in a pretty tight range. So expecting big moves in price with any ending stocks that we could see here this year is unlikely unless we see a major change, probably sub 1.6 in the balance sheet on corn. So what's driving the corn balance sheet? The U.S. is competitive here basically through April and May. You can see the comparison for prices to Japan. The U.S., whether out of the PNW, out of the Gulf, is competitive with any other origin in short term, and that should continue, like I said, into April and May. One of the big differences that we're seeing this year in comparison to last year is the Ukrainian prices. Last year we had cheap Ukrainian in relationship to the rest of the world that took some of the low end buyers out of the market and didn't have to come into the U.S. for corn. This year the U.S. is the low value price, so we're continuing to see export sales every week, flashes every week. So that is driving New Orleans premiums for CIF, driving PNW values as well. So corn export demand, it's pretty much a routine set of business. This year, Mexico has been kind of a surprise. We've heard about that in a lot of calls. That demand just continues to sit here on the front end. The other pickup we're seeing is EU, and then just some additional buying from countries that would have picked other origins in the past. So the Mexico demand, like I was saying, part of that is the increase is going vessel out of New Orleans, which is driving some of those CIF values that we've been seeing here. We hear them talk about, will this continue? Is Mexico's program front end loaded? If you look at the unshipped corn sales to Mexico, we're near a high already, probably the highest that we've been in years for this time of year. And then it typically tails off for unshipped sales once we get out into March. So we'll need to watch the sales pace here over the next couple months to see if the Mexico demand is actually larger or if they front end loaded the program due to a change in politics. Some people are concerned that there will be tariffs on Mexican goods and that possible, they want to be in front of that in case something happens there. So every time we hear people talk about cash versus delivery, what this does is it drives the spread market, how much we get in carries for our grain. So, when we're looking at cash versus delivery, it has a direct effect on the spreads in the West, even though delivery is calced on Illinois River corn values. So we look at what CIF New Orleans is in a barge, back it off to the Illinois River, and then compare that to what delivery is out of any given Illinois River delivery facility. So if you look at December, we're above delivery. If you look at March, we're right at delivery. So, it's one of these markets where we are going to see spread curves firm, and we should watch that throughout because it does have a direct effect on how much carry we have in the market for our corn and our milo. So if we take a look at this chart on the right, this is Dees July. At one point in early September, that was trading outside of 37 cents. That's what you were getting paid to carry your grain. If you would have rolled at that point, today that's inside of 18. So the demand that the river is seeing for export is driving what we're getting for spread carries in the West. So even though we can't participate in delivery in the West, it, correlates to how much we can get paid to carry our grain. And it's pretty much every spread from Dees March, March, May, and May, July. We're 5-6 cents inside on March, May, and May, July, and Dees March took the biggest move of over 10 cents. We expect if we stay near delivery, we'll have to watch how the December contract plays out when we get into delivery next week. But if Dees March continues to firm in towards even money or in inverse, likely the same thing will happen on March, May, or May, July, that they will follow the front end spread. Just to give you an idea of the delivery territories, I kind of highlighted each of the areas that are delivery points. That way, if you ever have questions, these are the points that when everyone's calculating cash versus delivery, these are the areas, they're barge loading facilities. And I think eventually the contract's looking at making a move towards rail execution, which then would allow the West to use the spread market for actual hedging purposes and just not relying on Illinois River and CIF to dictate where spreads are going to move. So flat price outlook, we've been grinding here between 410 and 430 for what feels like quite a while here. I don't really see that changing here. Even if we hit the high end of exports, we still have a comfortable carryout that probably doesn't need to move the market much higher. Same thing for new crop. We've been in a pretty steady trading range. I think one thing to look at is the corn bean relationship for next year. We're probably going to see more corn acres, and we'll see a carry out likely over 2 billion bushels again. So I think anytime you get a rally, those should probably be rewarded with farmer selling. For us to have a big breakout, we probably need to be sub 1.5 in carry out. And otherwise, I think you're just going to meet farmer selling anytime that board gets near 430 in the front month. One thing to realize too is once we roll over to the March, it probably turns into the March sells off to where the D's kind of went off the board at. So if that's 425, March will probably find the same trading range that we've been grinding in here for December. And then wanted to look at corn prices for the last 10 years. Very rarely have we seen us move really above 475. During the Russian invasion of Ukraine, we made a big move higher. Otherwise, we kind of grind in this $4 to $5 range for quite a while. So, if you see any opportunities and we break out to 450 against the front month or 475 for new crop, those are probably pretty good values to look at selling, especially if we are going to have another good crop behind this current carryout. One thing that we have seen that I thought might move the market more than what it did is the funds have actually covered their short position. They are now long corn, and yet we still are unable to really break through 430 in the front. That tells you there is a lot of corn that wants to get sold anytime this market does find a 5 or a 10 cent rally. So for us to really break out, I mean, one, you're going to have to find a lack of farmers selling, and the funds are going to have to continue to add to their corn length here. And if we do have another, in March or April, get good planting intentions, it's going to be hard for them to continue to add to this fund position. Ethanol margins, just wanted to touch on them. They are positive. They're not great, but you should continue to see guys continue to grind corn for ethanol here, even with not great margins. And that'll be another component of the carryout structure. If we can see ethanol margins increase, maybe they can increase the grind for corn. But at least if you're positive ethanol margins, you should continue to see those ethanol plants run. Sorghum outlook, the export demand continues to lag previous years. The main driver is China. USDA has us doing a similar program to past years of 220 million bushels, but our current commitment's only 40 million bushels total. And China is probably the biggest lagger, being a couple million tons behind their buying pace of last year. So what could happen in the milo market if China doesn't show up? Sorghum will have to find a domestic feed home. And the reason I touched on spreads earlier is, if the corn market is going to stay firm with export demand, we're not going to get paid to carry sorghum. I mean, you're going to be sitting there accruing costs and really not getting any help from the board and paying for carrying sorghum forward. So, for us to really get a premium rally here, we're going to have to find China. And, there's been some export demand, but it's been a boat or two here or there, and they have not come in for that big tonnage. So something we'll have to watch come the spring is, if sorghum has to move into the domestic market, what is that going to do to corn premiums? And, also, how long do you want to carry milo hoping for export demand if we don't have carry to pay for it? So the Western corn outlook, this is just kind of my ideas. I'll let the guys touch on corn later. Truck bushels are going to continue to set the price short term. Every market we see, truck is a considerable discount to rail replacement, whether it's BN or UP values. I think longer term, we could work towards rail replacement, but I think a lot of that is going to depend on if milo has to work its way into the ration. And also with feed wheat trading sub 100% the value of corn today, we could see some wheat work its way into the ration as well. So there's quite a few things here that could change the premium structure, and probably puts a cap on how high values could move. I don't know if we'll move to the same values we saw last summer, just due to there being more optionality in what can be fed. So that's about all I have for today.